Hello and welcome to StudyIQ. In this lecture, we will be discussing about the RBI's new monetary policy wherein which the Reserve Bank of India has hiked the repo rate to 6.25%. So, we will discuss about the hike in repo. So, we will discuss about the hike in repo in particular and regarding the monetary policy in general. So, let us start. So, as we said, one important thing in the monetary policy was the hike in the repo rate. So, let us first see what is repo rate. Before we move on to the repo rate, we must understand what is monetary policy. So, what is a monetary policy? Monetary policy means the policy that is related to the money supply in an economy. And with regard to monetary policy, one thing you must remember is that monetary policy is taken by the central bank of an economy. So, in case of India, the monetary policy is taken by the RBI. So, this point you should remember that monetary policy is taken by the central bank of an economy. We also have fiscal policy. So, fiscal policy is taken by the central government of an economy and monetary policy is taken by central bank. This point, it should be very clear for you. So, in case of India, RBI or the Reserve Bank of India deals with the monetary policy. So, coming to the monetary policy in a country, we said that this is taken by the central bank and in case of India, this is the RBI. And again, monetary policy can be broadly divided into two categories. One is contractionary monetary policy and second one is expansionary monetary policy. So, we have contractionary as well as expansionary monetary policy. As we said in the beginning, monetary policy is in relation to the money supply in the economy. So, the policy deals with increase or decrease in the money supply in the economy or the quantum of money supply in the economy. So, coming to contractionary monetary policy, from the word itself you can make it clear. So, contractionary monetary policy contracts or decreases the money supply in the economy. So, now coming to expansionary monetary policy. The term expansionary means expansion or increase. So, this deals with increasing money supply in the economy. So, coming to monetary policy, it deals with increase or decrease in the money supply in the economy and it is broadly of two types, contractionary which deals with decrease in money supply and expansionary which deals with increase in money supply in the economy. So, this is in short monetary policy. And there are certain tools or various tools of monetary policy. Let us see what are the tools of monetary policy or monetary policy measurements. The first type of monetary policy is the CRR or the cash reserve ratio. Cash reserve ratio means the amount of total deposit or the percentage of total deposit a commercial bank has to keep with the RBI or reserve with the RBI. So, this is the percentage of total deposits of a commercial bank it has to keep with RBI. So, now let us see how cash reserve ratio has an impact on money supply. Let us take an example. So, suppose the total deposits of a commercial bank is 100 rupees. Suppose it is 100 rupees and cash reserve ratio is 10%. So, it means 10 rupees. So, subtracting the cash reserve ratio from the total deposits, we will get 90. So, rupees 90 is the amount that the commercial bank has for lending. So, here in this example, the bank has 90 rupees for lending purposes, subtracting the cash reserve ratio. Suppose the RBI or the Reserve Bank has increased the cash reserve ratio. Earlier it was 10 as we said in the example. Now the total deposits is again 100 rupees and Reserve Bank has increased the cash reserve ratio to 20%. So 20% of 100 rupees 20. Subtracting cash reserve ratio from the total deposits, we will get 80. See, in the previous example, we saw that the cash reserve ratio is 10 and the money banks have for lending is 90. But coming to the second example, the banks have lesser amount or now the bank is having only rupees 80 for lending purpose. So, what does it mean? An increase in the cash reserve ratio can decrease the money supply in the economy. So, whenever the Reserve Bank of India increases the cash reserve ratio, the intention of the Reserve Bank of India is to decrease the money supply. And this is the first monetary policy tool. The second one is SLR or statutory liquidity ratio. Statutory liquidity ratio refers to the percentage of total deposit a commercial bank has to keep with itself. This is with itself. In case of cash reserve ratio, we said that the banks have to keep with RBI, but this is with the commercial bank itself. Again, like in the example of CRR, here also an increase in SLR or statutory liquidity ratio will decrease the money supply in the economy, and a decrease in SLR will increase the money supply in the economy, and RBI uses SLR as a monetary tool in order to control the money supply in the economy. Thirdly, we have the repo rate. Repo rate means the rate at which RBI lends to commercial banks. So, in case of repo rate, it is RBI lending to commercial banks. So, RBI lends to commercial banks at a particular percentage of interest, and this interest is known as the repo rate. So, when the repo rate is less, that means the interest at which Reserve Bank of India lends to commercial banks, when that rate of interest is less, what will happen? The commercial banks will borrow more. So, when repo rate is more, what will happen? The interest is high. So, with high interest, commercial banks will borrow less money. So, when the borrowing of the commercial bank increases, money supply increases. And when commercial banks borrow less, money supply decreases. So, when repo rate is more, the money supply in the economy is less. Why? Because when repo rate increases, commercial banks will borrow less from the RBI, and therefore the money supply in the economy is also less. Next, we have the reverse repo rate. We said that repo rate is the rate at which RBI lends to commercial banks. So, coming to reverse repo rate, it is the rate at which commercial banks will lend to RBI. So, if the reverse repo rate is high, what will happen? Commercial banks will get more interest from RBI. So, obviously, commercial banks will be interested to lend to RBI. So, when reverse repo rate is high, the lending of the commercial banks to RBI will increase. Therefore, money supply will decrease. How? If commercial banks are giving more money to RBI, the commercial banks will have less money to lend to the public. So, the public lending will decrease and lending to RBI will increase. So, an increase in reverse repo rate means money supply comes down because the public is getting less money from the commercial banks. So, increase in reverse repo rate will lead to decrease in money supply, and this is another tool used by the Reserve Bank of India in order to control the money supply in the economy. Next one is bank rate. Bank rate is again the rate at which RBI lends to commercial banks. So, RBI is lending to commercial banks, and we have seen that repo rate is also the same thing, RBI lending to commercial banks. But what is the difference between bank rate and repo rate? Bank rate means the RBI is giving loan. So, this is in the form of loans. So, the bank rate is against the loan issued to them. So, commercial banks are taking loans from the RBI when it comes to bank rate. But in case of repo rate, the rate is with regard to repurchasing the securities. So, repurchase of securities. So, there is a difference between bank rate and repo rate. That is, repo is with reference to repurchasing of securities, but bank rate is loan. So, RBI is providing loans in case of bank rate and repurchasing of securities in case of repo rate. So, that is a difference between bank rate and repo rate. So, coming back to bank rate, we said that RBI is providing loans to commercial banks and RBI would charge some interest for the loans, and that interest rate is known as the bank rate. So, what will happen if the bank rate increases? When the rate of interest increases, the commercial banks will borrow less. So, when bank rate increases, the borrowing of the commercial banks will come down, and therefore the money supply in the economy will come down. And suppose if there is a decrease in bank rate, the borrowings from the part of commercial banks will increase, and that will increase the money supply in the economy. Next is the MSF, or the Marginal Standing Facility. So, what is MSF? In case of emergencies, this thing is important. In case of emergencies, the banks will borrow from RBI. So, commercial banks borrow from RBI. And how do they borrow? The commercial banks will pledge government securities. So this is in case of emergency situations. So needs of emergency liquidity. The commercial banks will pledge government securities, and this is done overnight, or we can say that this is for a very short period. So in case of emergencies, the commercial banks will borrow from the RBI by pledging government securities, and the rate at which the RBI would provide such emergency liquidity to the commercial banks is known as marginal standing facility. And if suppose the MSF is high or marginal standing facility is high, what will happen? The commercial banks will not borrow much from the RBI. So it will lead to decrease in money supply. And if suppose the MSF rate is very low or low, what will happen? Commercial banks will borrow more from the RBI, and this will inject money into the economy, increasing the money supply in the economy. And again, one more thing here. What is the difference between MSF and bank rate? Bank rate, we said this is a kind of loan provided to the commercial banks, and the rate of interest is known as the bank rate. MSF, we said this is for emergency situations. So the basic difference between MSF and bank rate is that MSF is for a short period, and bank rate, it is for a comparatively longer period. So the time is the difference here. So these are the monetary policy tools. First one CRR, the second one SLR, third one bank rate, fourth one repo rate, fifth one reverse repo rate, and the sixth one MSF or the marginal standing facility. And we have seen that an increase in any of this will lead to decrease in money supply. So the RBI can increase any of this in order to decrease the money supply, and if any of this comes down, the money supply in the economy also increases. So this has an inverse relationship. So an increase in monetary policy tools will lead to a decrease in the money supply and vice versa. And hope this is clear for you. This is the basics of the monetary policy, and this is very important. Make sure you have a clear understanding of all these things in order to understand what are the current events. And coming back to our current affair, that is the hike in the repo rate. We said that an increase in any of the monetary policy tools or the rates will lead to decreased money supply in the economy. So when repo rate has been increased by the Reserve Bank of India, what is the impact? The money supply in the economy will come down. And why should the money supply in an economy should come down? When money supply in the economy comes down, this will curb inflation, or this will control inflation in the economy. So increased money supply will lead to increased rates of inflation in the economy, and when money supply decreases, inflation also decreases. And who has taken this decision? The monetary policy decision of increasing the repo rate has been taken by the MPC or the Monetary Policy Committee. That also you should remember. And according to the MPC, the Monetary Policy Committee says that the decision on increasing the repo rate was taken to achieve medium-term target of controlling CPI inflation, Consumer Price Index inflation, and the target of MPC is 4% plus or minus 2. So this is the inflation target of the MPC, and also the second one is to support growth. So these were the two factors the Monetary Policy Committee has taken into consideration while deciding the repo rates or while increasing the repo rates. Here you should understand one more concept, that is the monetary policy dilemma. The objective of any monetary policy will be two. One is inflation control, and the second one is growth of an economy. So these two are the major objectives of any monetary policy. Coming to first objective, that is inflation, we will see that in order to control inflation in an economy, the monetary policy or the monetary policy authority in an economy must try to control the money supply or decrease the money supply. So when money supply decreases, inflation also comes down. This is with regard to inflation. Again, coming to second objective, that is growth. In order to boost growth in an economy, what should happen? Money supply should increase. So when money supply increases, economy grows more. So there is a dilemma. Inflation should be controlled in one hand, and on the other hand, growth also should be encouraged. So there is a dilemma with regard to the money supply, and this is known as the monetary policy dilemma. Again, coming back to the increase in repo rate, the Monetary Policy Committee puts forward certain reasons for the increase in repo rate. Let us see what are the reasons. First reason was a sharp spike in the retail inflation. So there is an increase in inflation, and as we said, in order to control inflation or in order to decrease the rate of inflation, money supply should come down. And in order to reduce the money supply, what will the Monetary Policy Authority do? They generally increase the rate of any of the monetary policy tool, and in this case that is a repo rate. So what happens when inflation is high in the economy? It means money supply is also high. So in order to bring down the inflation, money supply should reduce. So in order to reduce this money supply, the Monetary Policy Committee has increased the repo rate, and we have said in the discussion on repo rate, an increase in repo rate will decrease the money supply in the economy. The second reason Monetary Policy Committee puts forward is the hike in crude prices. We have seen there has been an increase in the crude prices, and this has led to increase in the prices of commodities, which we call as inflation. So what is inflation? Inflation is the persistent rise in the prices of commodities. So with an increase in the crude price, the prices of commodities in the market has increased. So this is also inflation, and in order to bring down the inflation, the Monetary Policy Committee has increased the repo rate. But one thing you must understand here is that an increase in the crude prices, this is cost push inflation. So if we look at cost push inflation, this is not caused due to excess of demand. This is caused due to an increase in cost of production. Here in this case, the crude prices has increased, and this is cost push inflation, and monetary policy has lesser effect on the cost push inflation. This thing you should understand. And third reason is there has been a better GDP for the last quarter of financial year 2018. So better GDP means better output in the economy. So when output in the economy or GDP in the economy is high, it means that people have more employment, people are getting more wages, and the standard of living of people are high. So better wages, better employment opportunities, better output, etc. will lead to increase in demand. So an increase in demand will cause excess of demand, that is aggregate demand will become more than the aggregate supply, which will lead to demand pull inflation in the economy. So with demand pull inflation, again the prices of commodities will increase, and in order to curb the demand pull inflation, the Reserve Bank of India has planned to reduce the money supply by increasing the repo rate in the economy. So these are the reasons for which the repo rate has been increased. Let us also quickly see what were the key highlights of the monetary policy announcement. The first one, as we already said, repo rate increased by 25 basis points, and now it is 6.25%. Second one, reverse repo. We have said what is reverse repo. So reverse repo rate adjusted to 6%. Again, we have seen what is MSF and bank rate. According to the new monetary policy announcement, the marginal standing facility and the bank rate is adjusted to 6.50%. And again, coming to the CPI based inflation forecast. So according to the MPC, the CPI based inflation forecast is 4.8 to 4.9% in the first quarter of this year and 4.7% in the second quarter of the financial year. And the estimated GDP growth is 7.4% for the financial year 2018-19. So these are the key highlights of the monetary policy announcement. Monetary policy and monetary policy committee is very important for any examination point of view. So this is a very important topic.